Welcome to you all, and thanks for being part of the InvestorDaily Managed Accounts Roundtable, which we're doing in partnership with Macquarie. Managed accounts have been around for a while now, and clients are becoming pretty good at understanding what they're all about. What seems to be less clear, though, are the benefits for advisors and licensees, and that's what we'll explore today. We'll look at the implications of adopting managed accounts as an asset class, as well as the practical ways they can help advisors grow their businesses. One thing's for certain, though: awareness and understanding of separately managed accounts, more commonly known as SMAs, is increasing in the market. So, Nick, perhaps we'll start with you. Look, there are a lot of advisors out there who provide guidance on stocks as well as trading solutions. So how can SMAs help these guys solve scale, efficiency and growth issues in their businesses?
Using SMAs as an investment solution or as part of an investment solution, it changes the conversation with clients, and it changes the conversation away from individual investments to more holistic issues, whether it be about the client or about global markets. And from my experience, clients walk away from those conversations feeling that they've got a stronger grip on, or a stronger relationship with their advisor and a stronger grip on their investments. There's a lot of underlying benefits of using SMAs, which we'll talk about later, I'm sure. But I still think that it's very early days for SMAs in Australia, less so in the US. But clients, enormous number of clients still aren't familiar with them. Number of advisors aren't familiar with them, but it's growing very quickly, and the benefits are very clear.
Advisors typically have more of a skew towards managed funds, but they really want a solution that provides more transparency and tax effectiveness. Is that what you found, Brett?
I've also found clients, their goals haven't changed. They want a return on their funds. They've got retirement needs that they have to fulfill, and they're asking different questions these days. With technology and information that's around, they're able to ascertain very quickly what's happening in markets, and when they're asking those questions, they need to be able to see solutions very quickly. So transparency is a big issue that people are after, and it's also a fee conversation as well. They want to be able to have sophisticated solutions delivered at a cost, very different to what it was 5 or 10 years ago. So, we've got to be able to keep up with that need and find those solutions that are fitting into that client conversation, like Nick said. So that's where we want to focus our attention.
Bianca, from the licensee point of view, so I guess licensees want to manage risk in their businesses, and they probably want to have a bit more control over strategies and options. So how can managed accounts help them do that?
I think for licensees it's really about sustainability, margin and compliance. And I think that managed accounts really talks to all of those different components. So I think it's a powerful message when licensees can deliver an outcome that shows that you have consistency of client experience as well as consistency of client return without having to worry about a capacity risk. So I think that it's becoming more and more compelling for licensees to become involved. There's also this understanding around wanting to deliver core capability to advisors, and that could be in the way of maybe research delivered in an SMA sort of structure, which could just to gain scale and efficiency in the practice. Otherwise, it could potentially be SMAs used for asset allocation or part of the asset allocation story.
So that, from an advisor's point of view, what are you seeing in the SMA market?
Probably innovation. That's probably the big thing. I guess whether it be strategy bias from an investment manager perspective, or just even, real return strategies in SMA. I think that's a big plus for our business anyway. They're probably the two key things that I'm seeing. Aside from that, it's probably becoming more normal. Whereas previously you talk to a client about an SMA and they'd say, what is this thing? We've had the direct share exposure, we've had the managed fund, ETFs, now we're talking about SMAs. So it's a combination of all those, and it's just becoming much more normal and part of our ongoing conversations with clients.
How about you, Stephen?
Yeah, for us, it's about the consistent outcome. It's, I think our clients have a preference for owning their investments and having that direct equities exposure. The issue for us is that as we've grown, we've lost the ability to be able to deliver the true value we're looking for and to be able to manage the portfolios ourselves. SMAs give us what we're looking for in that space. It gives us the scale and allows us then to concentrate on where we see our true value, which is around the strategy advice.
If I can add to that, I think from an advisor's perspective, it's quite simple, quite easy to market SMAs as a premium solution. It is a step up. There are significant benefits between stepping up from a managed fund to an SMA, and if you can outline those to the client, they get a sense that they've got a premium solution that comes at no additional cost. And I think that, when building a business, in addition to all the scale benefits, is really powerful because you can close that client.
From a cost perspective as well, though, if you look at Nantary's managed fund or SMA, 46 basis points, pretty cost-effective solution, while still being able to do it at scale, compared to a managed fund doing something similar for close to 1%. You see they're going, hang on, you're getting a premium solution where you've got that direct ownership, the transparency, and I don't know if you guys show the clients the full portfolio valuation, but that seems, for most of my clients, that's a real value add, saying, wow, I'm getting a fantastic service, I'm paying less, and we're almost competitive with industry funds.
It's very powerful, the ability to show the client what they own and deliver that at a price comparative to industry funds, much cheaper than managed investments, with the ability for the client to receive dividends, to receive franking
Corporate
credits.
actions.
Corporate actions to be automated. It's fantastic.
What are some of the challenges that you're seeing in the market that can be solved by managed accounts, maybe particularly when it comes to efficiency and scale?
Having our own AFSL, we see both sides of the equation, the compliance side from the AFSL and also the advisor journey as well, and what frustrates them and their ability to earn a good income. So, having the ability for portfolio changes and recommendations to be made very quickly without a burdensome compliance obligation, i.e. an ROA. From a licensee point of view, we sit there and go, well, that's a fantastic outcome for us. It reduces our risk. We know where all our clients' money is held, in which model, and how it's being, how it's performing, and communication with the model portfolio providers. From an advisor's point of view, when you take out that ROA requirement, that's a huge burden from their workload. Most advisors, by their nature, are people who are out there looking for new business and trying to grow their client books. And at the end of the day, all we need is time. And when you take that part out in terms of an obligation and give them back that time, their headspace changes, their creativity changes, their relationships go up, and a funny thing happens, they start to write more new business. And from those sides of the equation, it's a win-win. The more they make, the more the licensee makes, but the more we give in terms of time and space back to the advisor, they get a better work-life balance as well. So across the two over, it's been a fantastic outcome.
What about costs and margins? There's more and more transparency around costs in the financial planning sector. Clients want better value. So how do SMAs help you when it comes to that kind of thing?
As I mentioned just previously, 46 basis points, 1%, there's value. It's all about perceived value, I think, for clients. SMAs truly, help you as an advisor, especially with FDS obligations. It's becoming a burden. You need to show value to clients. An SMA solution compared to a single managed fund for your Australian share or just even a diversified fund, they see value in that, albeit they don't need to know that as a business we're actually much more efficient as to how we deliver that solution. So I think, reasonable basis, client value, it's a win.
And it does shift the advisor's focus to just finding more and more clients, as Brett said. You know that every client you add and every dollar of funds under management you add, you're able to apply your advisor service fee, and you know the solution will look after itself. And you can far more easily express your value proposition when you're not trying to position yourself as the best investment manager in the country. You're just saying, this is what I do, this is how I do it, we use premium products, and we're really confident that you're going to get a good solution.
Let's think about what type of clients benefit most from SMAs. Perhaps we can build a picture of the ideal client. So we've talked already about the transparency of managed accounts. So I guess they're going to appeal to people who are not that interested in stock picking themselves, but want to be able to see what's happening. What's your idea of a sort of an ideal client?
Our view would be what technically we call as a delegator, the client who actually sits there and says, you guys are the experts. My life's complicated enough. I don't need to frustrate myself even more by managing my own money. But they're smart enough and intuitive enough to know how the financial planning industry has traditionally worked and where the world is heading. So although they're outsourcing the expertise, they still want to be able to understand and still feel comfortable that they're not being taken for a ride. And that's where this solution comes in. It fits right between the two. You go best of breed, low cost, best interest duty satisfied, and you still the most involvement in the portfolio you need to have if you want to is checking your iPhone to see where the account is, or getting online and seeing the PV. There's no more reports. It's not coming in for a meeting. So for clients in this day and age, those delegators, it fits perfectly. Clients still want to have some input like we've spoken about, then hiving some off and letting them have control over that aspect still allows them to fit. And if they go the other way and it's more bespoke and highly evolved, well then there's models for that, but that's not the type of business that we offer. But it's still out there. There's still clients who want to do that.
Stephen, what's your picture of like an ideal client?
I really see it's appropriate for many different types of investors. I think the small account balances, because of the minimum size, makes it difficult. And I think someone that wants absolute control over their portfolio, SMAs are not an option, but I think they have a lot of characteristics of managed funds and direct portfolios that appeal to most clients. And we see that for the majority of clients out there, SMAs are an excellent option.
Yeah. I'd agree completely. It's most of our clients, they'd be an ideal fit, albeit we probably need to get our own white label solution. But at the end of the day, whether it's an accumulator client, a retiree client, it can be a core plus satellite approach, going for some alpha through the satellites. It just makes sense. There's lots of, the world is evolving, or the SMA, the managed account world is evolving. So you can almost find a solution for 9 out of 10 clients.
I think advisors that have historically been stock pickers and see themselves as the investment managers are guilty of selling that approach to all of their potential clients, when a number of their potential clients just aren't appropriate to understand the information that's required to make a decision, perhaps aren't available. So I find that there's a short list of people who are busy and who can be who should be delegators, aren't appropriate for stock pickers. They should be in a managed solution. They want the best that they can get, but they can't be involved because they don't have time, or they don't want to apply their time. Equally, when there are family members involved, multiple family members, a managed solution is a far easier solution to get unanimous support for that solution. So when you've got siblings, or you've got a range of family members around the table, you can present a solution that is not based on my input, it's more based on a sustainable strategy. You've got a solution that they'll all support. Equally, those people that might manage money directly themselves in their own name, but they're self-managed super fund perhaps, they'd like to take a slightly more professional approach and not as high risk. So again, you might have a client that you can do in 2 different accounts, take 2 very different approaches, but an SMA would be appropriate for part of that. We're finding also that with the wealth sitting with the 60, 70 and 80-year-olds in Australia, there's a lot of widows out there that have always delegated the decisions to their husband. Their husband is no longer there. That widow is no longer suitable for the direct stock type approach. Switch them into a managed solution. And we found that that's a real comfort to those people.
Let's now look at some of the potential drawbacks of SMAs and perhaps some of the counters to those. So, look, SMAs have developed pretty rapidly over the last several years, but there's still a pretty long way to go until there's the same range of offerings with SMAs than there are as traditional managed funds. So how do you get around that?
From my point of view, it has to be a demand-driven, a bottom-up approach from the advisors, referring back to the licensee and to the product providers to go, this technology doesn't work anymore. You need to move to a more open architecture. So from my point of view, that limitation just has to be driven from the people in the industry. And if the money flows that way and it's coming out of here and over to here, a funny thing happens. Everybody follows the herd, and it'll occur. So,
Do you think that bottom-up demand is coming from advisors?
Absolutely.
drive more?
Fund managers know that the advice market is demanding SMA product, not necessarily the client. The demand is not coming from the client; it's coming from the advice. And fund managers now, we find, they might have a managed fund that's been very successful, and it might be a couple of $100 million or several $100 million in size, and they're now developing an SMA. They're happy to put out their intellectual property and for that to be visible, knowing that if they don't build an SMA, they may lose FUM. And from my perspective, if I've got two choices between selling a managed fund or selling exactly the same strategy in an SMA, it gives me the ability to show the client exactly what that fund holds, what that manager holds, what strategy is in place, and again, it's comforting for the client to be able to see that.
Being at the forefront of SMA development and very market facing in that way, it's the demand. As the demand grows, then the functionality will be built out, and it was on that point around the added functionality of customisation of tax overlay, the next generation of SMA, and I think that will definitely come from the demand. So we're looking at potentially a $70 to $80 billion market at the moment. In the US, it's a $4 trillion market. Clearly it's not a direct comparison, but there's definitely a message there in terms of there's a growth story that's occurring.
Similar to ETFs, isn't it? It's the comparison with America. It's high growth, quick growth, but it's of a very small base. Do you think we're going to see a diverse offering of SMAs?
I think we're already starting to see it. I think it's just, you touched on it with the ETF. You look at the ETF story, and it was such a slow uptake initially. Once everyone gets, people start getting involved in SMAs and having SMAs, the understanding will grow, and all of a sudden, it's just going to spike. That's the way I see it. But I think from a product offering, there's probably still a few more asset classes that need to be looked at. That's where I think the big issue is for me. That's why I look at the diversified fund as a core plus satellite. But aside from that, they're going, once they look at some of these other asset classes, I think the rate that it'll grow will increase.
I don't actually see a place for managed funds long time. I just, as the functionality improves and the investment menu grows, I can't see a reason why you would continue to hold a managed fund. And so I think SMAs will completely take over that space.